All right, Mike, I'm going to get started. There are people logging in, but we'll try to begin on time.
Great.
Good morning, everyone. Welcome. Thanks for joining us today. Today's webinar is the Merger Fallacy. It's the continuation of MSIC's webinar series regarding long-term credit union issues. The presentation is going to be led by Mike Hanson, our MSIC's president and CEO, and it's going to address the facts, the truths, and misconceptions about mergers and the positive and negative impacts of mergers on your credit union members and the credit union industry as a whole. When Mike concludes his presentation today, we want to invite you to be part of an open discussion about this topic and, also an opportunity for Q&A. And everyone should feel free to participate. All participants can click on your raise hand button. And when you do that, I'm able to unmute you, and then you can just jump right in and participate. All we ask is you introduce yourself and then, share your thoughts or your questions. And with that, I will turn it over to Mike.
Thank you, Erica. Thank you, everyone, for joining us. Good morning. As Erica said, this is the third in our long-term issues series that we're doing all through this year. We'll talk about the schedule when we're done. But today I want to talk about the merger fallacy. Now, I'm going to say some things that might shake some of you up. I'm going to say some things that might surprise some of you. And I'm going to say a few things that hopefully will cause you to take a good hard look at your current operation. So when we look at the MSIC Cooperative, we see a very healthy set of financial institutions. Assets are way up. These are September 30th numbers, but for the December 31 numbers, they're consistent. Assets are up almost 5%. Capital is over 11%. Delinquencies are low. For the most part, our 72 or 3 member credit unions are well run with experienced leadership, and all but 4 of them are well capitalized under the NCUA's prompt corrective action regulations. So it's a real success story over our 61 years. Membership numbers are up as well on average. However, when you take a longer term view, there are some warning signs flashing for our cooperative and for credit unions generally. And that's the purpose of this series this year. Now, all of our webinars are on MSIC's YouTube channel. So if you missed the previous one, which was, there were 2. One was Managing Contagion, which thanks to Silicon Valley Bank, we threw in there at the last minute. And the other one was Managing an Aging Membership Base. I recommend that you go back, if you missed those, go back and take a look at them on our YouTube channel. Today, we're going to talk about mergers, but it's really in the context of credit union culture. So a little bit of reminder about who we all are. We're the first in the nation to provide deposit insurance to credit union members. We're a true cooperative, 73 institutions with almost $32 billion in total assets. We've been around for 61 years. We have over 11% capital. That's $3.4 billion in capital collectively. We today insure over $2.5 billion in excess shares and deposits, and we all serve about 1.7 million consumer and organizational members. And MSIC itself is the 4th largest credit union cooperative in the world. And in those 61 years, no consumer has lost a penny of their savings or been denied access to their funds. And that's really a true accomplishment that we can all be very proud of. So mergers. Nearly all credit union CEOs and their senior teams spend a significant amount of time and effort seeking merger partners for their organization. That's because historically, mergers were an important tool in growing a credit union's membership base. However, the digital world we now live in, and for the last 20 years we've lived in, has dramatically changed the financial dynamics of growth, but credit union culture is extremely slow to evolve. So let's look first at the likely scenario over the next year or 2, because everything we talk about is in the context of our economic and operational challenges that we're going to face. Right now, on average, our credit unions suffer from an out-of-date walk-in operational culture. Whether we like it or not, that's what we've done for decades, and we are very slow to change that culture. We face a new pattern of consumer behavior. It's not caused by the pandemic, but it was brought forward by the pandemic. The movement of the consumer to a digital platform for most of their activities, including financial services, started long before the COVID pandemic. But all the analysts seem to say that the pandemic advanced that by about a decade. So consumer behavior today is totally different than it was prior to the pandemic. And that includes the purchase of their financial services. And we have a new array of financial services competitors, and they're not local. They're from all over the world. Competition is newly forming, and it is a dynamic playing field. So the competition for consumers' financial services is not only fierce today, it's going to get fierce and more diverse in the years to come. Now, we're in a rapidly rising interest rate environment. Silicon Valley Bank shows that there's a generation of financial institution leadership that has never experienced an interest rate environment like this, and man, did it show. Yes, the Fed missed it with Silicon Valley Bank, and yes, there were lots of issues like that. But Silicon Valley Bank's collapse in 3 days was a result of massive management failure to recognize the dynamics of a rising rate environment and to conduct appropriate asset liability management practices. There's no getting around it. You can't go on Wednesday from a well-capitalized, well-run, bank that has a reputation of being on the cutting edge to losing $42 billion in one day and being insolvent on Friday. That's what happened, and that's a massive management failure. So we're in a very difficult interest rate environment, and we shouldn't fool ourselves with the stability that we have right now. But after a long period of generational low interest rates, all financial institutions have a loan portfolio that needs to reprice. We're going to have lower loan demand due to the rising rates and a slowdown in both residential and commercial lending. Even with increasing interest rates showing a positive effect on our immediate earnings, as our investment portfolios reprice quickly at higher yields, a rising rate environment will also result in a much higher cost of funds. We're already seeing that happen over the last 6 months, and institutions are going to be required to compete for those deposits. So a lack of a vibrant new loan pipeline could lead to a loan portfolio being underwater or close to underwater in a rapidly rising interest rate environment, especially after this long period of generational low interest rates. If these loans are still on your books, these low interest loans will have a longer average duration, and consumers will keep them and not be refinancing anytime soon. So it takes time for the mortgage loan market to adjust. It is adjusting. We're seeing a pickup in some first mortgages and other loan products, but dried up loan pipelines are the result because the numbers of available loans are going to be much lower. So we're in for a period of compressed net interest margins and pressure on earnings. But it's also a period in which we're going to need growth in membership to produce a new loan pipeline. The current portfolio will reprice too slowly in this environment to keep up with the rising cost of funds. There's no way around it. It's going to be a bumpy ride for the next couple of years for all of us. So if we need a new membership base to increase or reestablish our loan pipeline, how do we do it? And are mergers the way to do it? Historically, they were. But the answer is no. Mergers are not an efficient way to grow your membership base, and a merger generally does not bring you new loan products in the amount you're going to need. They're bringing over their existing loans, and there's an opportunity for you to cross-sell the new members that join your institution, but generally that's not what you're looking for. Mergers demand a great deal of senior executive time. They have a long time horizon to accomplish. They are costly, not only in time, but in legal fees and in regulatory approval processes. They require a great deal of internal effort and adjustment to produce the expected synergies. They frequently result in a delay in growth and do not achieve the expected benefits. In most cases, they produce limited growth potential that's far lower than the CEOs went into them. Now, these are averages. You should always be open to mergers. And we have some members who do mergers extremely efficiently, but that's not the average case. Very occasionally, a strategic merger will arise, and they're very good to do, and they're worth all of the effort, but there's a lot of effort. And they are rare. True strategic mergers, we've had a couple in the last couple of years. They are actually pretty rare in most cases in the credit union industry. But you should not make mergers a central part of your growth strategy. They should not take the place of the hard work of actual growing your membership base. Senior executive time needs to be spent on that, and be open to mergers, but don't spend all your time trying to persuade other CEOs to join your organization. Growing your membership base is now easier and less costly. And as I said before, new members bring loans and new loan product. But on average, we're pretty bad at the merger game. We're not good at doing the mergers well, and we're not good at growing our membership base. Now, when you look, I'm using data as of September 30th, but as I said before, the December 31, 22 statistics are pretty much the same. When you look at membership growth, now I understand that membership numbers, are widely erratic, that we report on our call reports, because some institutions don't pay enough attention to what their active membership base is, but it's all the data that we have. But when we look at the growth over 2022, MSIC members are at 1.3% growth in membership. All Massachusetts are 2.8, but all credit unions nationally are over 4%, and it's actually a little higher as of December. Now, there's a couple of reasons for that, but let me talk about all Massachusetts credit unions. That's DCU. The difference is DCU. There's such a huge component in Massachusetts that they skew most of the numbers. For example, MSIC members account for 60% of all credit union members in Massachusetts are members of MSIC credit unions. If you take DCU out of the mix, that jumps to 76%. We have 3/4 of the non-DCU credit union industry is a member of the MSIC cooperative. But so if you take DCU out of that, all Massachusetts credit unions are pretty similar to what the MSIC members show, at about 1 to 1.5%. Now, on the nationwide level, why is it 4.5% for growth when we're at 1.3? Part of that is that nationwide credit unions have more consumer loans and fewer mortgage loans. We're the opposite. Because Massachusetts got into the mortgage business early for credit unions, we have a much higher percentage of our loans in mortgages, and that doesn't turn over as much. If the bulk of your loan portfolio are consumer loans, in order to keep them turning over, you have to have a much more vibrant activity at recruiting new members so you can get new, shorter duration consumer loans. But that still doesn't account for this wide 300 basis points difference between Massachusetts and nationwide. The truth is, we're not paying enough attention to it. Now, some MSIC peer groups, like those credit unions with less than 100 million in assets, have actually reported a net decline in membership over the past 5 years, including in 2022. All 3 of our peer groups under 100 million all reported negative membership growth. And of course, that's not good for the long-term future of those institutions. And of course, as I mentioned, and you heard in one of our prior webinars, credit unions suffer from a rapidly aging membership base. So what are we going to do? And we spent a lot of time working on this at MSIC over the past few years. What we have to do is we have to change our culture of our organizations. And I want to warn you, cultural change is extremely difficult. We have some steps that we recommend. One, kill the walk-in operational bias. Walk-in operational culture is dead, dead, dead. And if you didn't hear that the first 3 times, it's dead and it's never coming back. Now, what do I mean by walk-in operational culture? We have lived for 20 years on loan refinancings from our existing membership base, and our idea of sales is to increase the wallet share of our existing members. Consumers don't do that anymore, and you've seen 10 or 15 years of your branch statistics showing that fewer and fewer people are using your branch on a walk-in basis. Fewer and fewer of your loans are coming through the door with consumers coming to you. And if you're looking at the age demographic of who is using your branches, they're older. They look like me, and they don't look like your members of the future. So if you have an organization that has a walk-in operational culture, and I'm going to give you a hint, all of you do, you have some tough times ahead when you're trying to think about the long-term viability of your institution. Now, how did we get this culture? It's pretty simple. We've been around a long time, some of us for over 100 years, and we've had financial success and stability, and that's led to a complacency regarding the need to seek newer markets and younger members. And it's extremely bureaucratic. It's easy for your staff to have a walk-in culture. And if we were to sum it in one line, it's we service members who contact us on our terms and when we're ready. Now, a lot of you are going to disagree with that. And publicly, you're all going to disagree with that. And I don't blame you. But I want you to take a hard look at your operational culture. No matter what your job is at your institution, take a hard look at how you're actually servicing your consumers. And we've had a 20-year declining interest rate environment where loan refinancings of our existing portfolios drove our business. It doesn't work now, and it's not going to work in the future. This is credit union centric and not customer centric. We all talk about customer service, customer experience. There's, tons of advisors out there trying to sell us the new, buzzwords about customer centric. We talk the talk, but a lot of us, many of us, all of us, we're not walking the walk when it actually comes to whether your operation is customer centric. Step 2, before you can go out and change your culture, you have to improve your product offerings and your delivery systems. Start with loans. Newer, younger members need loans. They don't need deposits. It's life cycle investing basics. You got plenty of older members who have deposit needs. Now you need the younger members that are going to replace the older members in time and who are going to drive your asset side of your balance sheet by bringing in new loans. Your loan operations on average are pretty darn inefficient, and they're not adequately connected to both marketing efforts and customer service or engagement efforts. One of the biggest failures is even when you do get a younger member, you're not engaging that younger member and you're not marketing to that younger member to turn them from a customer, a consumer, into a long-term member. There is virtually no activity out there to link these two operational needs, and we've seen it time and time again. Step 3, sell, sell, sell. New members are out there. You have to go get them. You have to teach your team to sell, because if you've lived for 20, 30 years as a walk-in operational culture, I guarantee you, you do not have a team that knows how to sell. Structure your employment organization chart to outside sales, not inside sales. Cross-selling and increasing the wallet share from your existing members are good ideas, and should be pursued. And many of you have been pursuing them for some time, and you should continue to do that. But that's not going to bring in new members. That's not going to solve your aging demographic. Sooner, you're going to have a platform of membership that is too small to sustain your operation. It may not be next year, it may not be in the next decade, but it's coming unless we get really good at building a membership base and changing our organizational culture. 4, new media, not old. This is where the cost dynamics of growth have changed. Marketing used to be expensive and difficult and takes a lot of time. Now it's free. Social media is the key. Peer-to-peer selling. Younger consumers do not listen to your ads. They do not listen to TV ads. That's why TV ads are much louder than the actual show you're watching, because everybody is not paying attention and they're trying to counter that. This new marketing environment is cheaper by a mile. And when you add up all the costs, the cost of bringing in someone on your team that can do social media is going to be less than the traditional marketing cost of newspaper advertisements, radio advertisements, and television advertisements that have less and less effect. It's just a redirection of your marketing dollars. It is also way more effective. And this is where the battle is going to be won or lost for new membership. Step 5, we're terrible about telling our story. Tell the credit union story. You have substantial advantages. Younger consumers, according to the Federal Reserve's, every decade they do a values survey. And for the last 2 or 3 of them, younger consumers are altruistic. They're much more altruistic than my generation. We just sell your good works, your charitable activities, your community activities. This will attract them to your structure. Credit unions are owned by their members. A lot of folks don't know that. A lot of consumers don't understand it. They don't even know what we are. They think you have to be a member of a labor union to join a credit union. Get out there and explain to them what you do and why, and that they're your bosses once they join your credit union. Now, when you do this, I want to give you some guidance. Go stick it to the big banks, because trust me, they're sticking it to us, and they do it every time they can. And you have an unbelievable advantage that no other credit union in the country has. You have full deposit insurance, and now is a great time to sell that, as I'm sure you all know, thanks to, again, our friends at Silicon Valley Bank. Take the customer away. We have 1.7 million consumers are part of the MSIC cooperative, but we have several million residents in Massachusetts alone, not to mention the other states. There's lots of consumers out there that are not part of the credit union movement. Because the truth is, our 1.7 million is actually less than that, because many people are members of multiple credit unions. So we're probably touching about 1 million consumers in Massachusetts. That means there's several million more for us to go get. And they're not happy. Urgency. Cultural change must happen now in your organization to improve your performance dynamics and your ability to create a new membership base for the future. Got to be driven from the top of the organization. So you CEOs out there, I'm talking to you now, you have to drive this change. And you should expect dramatic and sustained resistance from your own organization, including your boards, including your staff, because humans don't change easily. And if you've had a career where you're used to a walk-in operational culture, and now you got to go out in the community and you got to recruit new members, bring them in and sell them products, that's a big change. You got to make adjustments as you go, but you got to stay with the program, no matter what, because the long-term future of your institution will not be served well if you have an aging membership base and you have an inadequate structure to go out and bring in new members. Mergers are not the key to fix this problem. Like it or not, the survival of your credit union depends on this culture change. It's really hard, but it's necessary. Now, I'm not just talking to the larger credit unions. All credit unions of every size can do this. For example, if you have 1,000 members and you want to increase that by 5%, that's not hard. You can go do that. All it requires is a change of focus. If you have 50,000 members and you need to improve it by 5%, you have a much bigger challenge on your hands. So in some ways, growing your membership base is easier for the smaller institutions, provided they focus and change their operational culture so that they are attuned to doing that. Now, the question is, we've been around for over 100 years, especially here in Massachusetts. We had the first statute in the early 1900s for credit unions in the nation. We have a long, rich, deep history. It's a great success story. Are we going to be part of the financial services landscape in the future? That depends on whether or not we can replace this aging demographic. So in case you didn't catch this, this is a contact sport. This isn't for the faint of heart. Take the customer away and then engage them to make them a long-term member. And your biggest resource right now is your existing membership base. They all have families, they all have relatives, they all have people they work with, they all have businesses that they work with, and they've already decided to trust you. Start with them. Go and use them as a vehicle to bring in new members. In short, you've heard me say this before about 1,000 times, we need to learn to compete. We need to convert our operations to a sales and high performance culture. Extremely hard to do, but doable and necessary. Don't be passive. Don't assume that what happened in the past will ensure your future. It won't. You've heard me say before, and it's a truism, what got you here ain't going to get you there. It's a new world out there, and you need to learn to compete and do it now. Now, I talk to a lot of CEOs, as you know. I do a lot of strategic planning. I do a lot of work with them. I try to help them. Anybody who wants help, we will give help to. And MSIC has tons of resources. And I know a bunch of you are sitting back and going, yeah, that's not us though. Yes, it is. Take a hard look at your actual organizational culture. CEOs, go talk to some of your customers. Go see how that last loan origination process actually worked. Find out if they'll use you again. You're going to be really upset if you find consumers that will tell you the truth, because we're not as good at our operational effectiveness as we need to be. And I've seen it time and time again over the last 20 years. Your entire organization needs to be focused on the new member. All parts of the organization should be coordinated to provide an exceptional customer experience. And one of the prior webinars, you heard me give a story about a young customer who got their first mortgage at one of our member credit unions. And it was a horror story, and they'll never go back. And they didn't go back. They refinanced with another institution a couple of years later. And there was absolutely no follow-up to try and make them a member, to engage them, to get other aspects of their wallet share, to find out how the process went. And the operational ineffectiveness of that credit union lost a young member. It's happening far more than you can imagine. Now, it can be done. This requires focus, performance, and culture change. Has to start, as I've said, with the CEO. The most progressive credit unions will be the one to enjoy long-term success. There are lots of consumers out there who are unhappy with their bank, and you need to go get them. Now, think back. DCU has had remarkable growth in Massachusetts. They are now, I think, over 10 billion in total assets. They are way bigger than anybody else. How many mergers did they do along the way? Not many. They are very, very good at bringing in new members through their coordinated activities. Now, DCU is not a member of the MSIC cooperative because they're too large, and they've been too large for a long time. Having them as a member would be destabilizing. So we can't ensure they're members, but they are a very good example of what can be done when you focus on internal consumer generation, consumer development, and then bringing them in as a member. You've got a great story to tell. I want you to go use it and go get them. Now, we're really bad at telling the credit union story, as I mentioned before. We're going to cover that in our next webinar on May 3rd at 10 a.m. I hope you'll join us. To review, you need to address this issue promptly, educate your management team and directors as to what needs to be done. Resources need to be committed to this effort, and you must break the mold of your operational culture. We need to run our operations differently, more effectively, and we need to do it quickly. So MSIC offers services, as I mentioned. Contact us if we can help you in terms of modernizing your operations or building consensus with your boards of directors, trying to help you move in the right direction. But time is really of the essence in gaining new members so that we can ensure the long-term success of our movement. Now it's your turn. Questions, discussion, comments, disagreements? I'm open for questions. Erica?
Yeah, hi everyone. So just again, if you want to participate, there's a raising hand button at the bottom of your screen. You just have to do that and I'll see that you're raising your hand and I'll unmute you. But we did get a few questions in, Mike, so while you were speaking, so I will go to those. So the question is, do credit union mergers ever create value for members, in your opinion?
Yes, of course they do. I think that's a very good question, though. They do create value for members. There are situations in which credit unions, for whatever reason, have gotten to the point where they need a merger partner because they may not be viable long-term, and smaller credit unions generally will look for a merger partner. And the larger institution or the surviving institution many times has a broader product mix, a larger membership base, so they can be more, cost efficient in delivery of the services. And so the actual consumer members will benefit in those cases. But if you're the CEO of an institution that's trying to survive long-term, seeking a merger is not always the best way for you to grow your platform. In fact, it can take a long time. It is difficult to develop synergies, etc. So the consumer can benefit, but the institution might not. Now, for larger credit unions that are operating effectively and efficiently, always be open to a merger. You can increase your size. It's good. Just don't think it's cheap, and don't think it's easy, and don't think it happens in a month. And there are lots of those of you who've done a lot of mergers. There's a lot to it, and making the synergies work. There's a lot to it, and it takes years sometimes to bring two good-sized institutions together. It's a very difficult process. Now, that should be in addition to your efforts to build your membership base, not instead of. And that's really our message today with the merger fallacy. 20 years ago, CEOs would tell me that's how they're going to grow their membership base. And I still do strategic plannings in which boards want to add, we're going to do a merger next year or in the next 3 years. And I always say, don't do that. That's a process you do not control. Don't give yourself something that you don't control. Be open to them, but don't make that the replacement for your growth strategy. You need an effective growth strategy, and that starts with operational culture change.
So, Mike, that actually runs into a question that came. So you basically just answered it, but just to put it out there, what about larger credit unions that include mergers as part of their strategic plan and growth strategy? Do you think that should be removed from their strategy altogether?
I do, and I always recommend that when I'm doing strategic planning sessions. I would rather have language that we're open to merger opportunities, but if you put it as one of your objectives, then the CEO is going to go out and spend all kinds of time working on something they don't control. You don't control a merger. You want to be open to it. You want to be receptive to it. You want to be able to deliver value so that a merger partner will want, your reputation is important, the value you deliver, that's all good. You want to do that. But that's in addition to what the CEO should really be doing. The CEO should be growing the membership base and building the long-term future while being open to a merger, but not making it one of your objectives. I always, those of you for whom I've done strategic planning, I also say the regulators look at your plan. And if you put in the plan, we're going to do a merger in the next 2 years. And then, of course, there aren't any mergers to do. They're going to come in and say, hey, you missed objective 4, you're shooting yourself in the foot. So be open to them. You can put that in your plan, but never make that your primary growth strategy.
So another question, yes, we need to grow consumer base, but what about aging boards and their impact on credit union management? Do you think there should be emphasis on refreshing boards? Do you think this is a priority as well?
Yes, of course. Yes, absolutely. And boards should be the ones leading that charge. We do a lot of board training here. We've actually got something in the works for one of our webinars in the fall on board succession and training that we don't have a date for, but we're working on it. We have an aging board. We have an aging management leadership base, which has turned over a bit in the pandemic. We have some new leaders out there, which is wonderful. Some folks advanced their retirement because of the pandemic, because of the stresses of the pandemic, and I get it. But boards need to police themselves, and boards do a terrible job of that on average now. We've got some great boards out there, but we've got some boards out there that really need to be slapped around a little bit. And some of you know that I have a tendency to do that because I love them and I want them to succeed. But boards need to police themselves. That really is not a job the CEO can do. And, either the chairman of the board or a lead director, which is a tool that not enough of us use, should be making sure that the board has a pipeline of new candidates, younger candidates. The board needs to make sure they have the skill sets that they need, and the CEO can help. The CEO's in a tough political position to drive this change. If you need a CPA on your board, you got to go get it. You need a lawyer on your board, you got to go get it. You got to make sure that all of your various membership groups are represented. So we have some institutions that, have the classic is a combination of firemen and city workers and policemen. And you want to make sure that if that's your membership base, you want to make sure that there are representatives from those membership base. And these things don't happen by accident. They have to be built. A successful board has to be built, and the board is responsible for that.
Okay. Does anyone else have any other questions? Please raise your hand or send them in through the chat box, which is what we've had for the last few questions. Okay, well, that concludes today's presentation. As Mike had said earlier, the recording of today's webinar and all of our webinars are available. This one will be available on our YouTube channel and our website. I will let you know via email when that is posted. And Mike's presentation is also available upon request, so just please reach out to me if you'd like that. My email address, as many of you have, is emorin@msic.org. And then as far as our schedule through the spring and summer, we're going to continue the series regarding long-term issues for credit unions with our next webinar on Wednesday, May 3rd. That's at 11 a.m. That's telling the credit union story. I've sent that link around, and you'll obviously be hearing from me again. We've also added a webinar regarding strategy, and that's going to be broadcast on Thursday, June 8th. I haven't sent out information on that yet, but please keep an eye out for that in the next week. And then on Thursday, June 22nd, we'll have the rebroadcast of our keynote speaker, Tim Barrett, who's the president and CEO of the Federal Home Loan Bank of Boston. And he was our keynote at MSIC's 61st annual meeting. So we will be rebroadcasting that. And then we will soon be rolling out our continuing series in the fall. Those dates will be to you as soon as we have them set up. And so we'll be continuing this discussion about credit union issues, long-term issues throughout the fall. So please do share these sessions with your management and your executive staff and continue to sign up. And we hope to see you on May 3rd. And yes, I see that. Yes, I will send the slide deck of today's presentation around. I just saw a question come in. And again, thanks everyone for being here. And we will see you soon. Take care. Thanks, Mike.
Thanks.